Hey everyone, this is the Trader Investor. In today's learning session, I want to talk about options because I do a lot of my videos, especially on the market analysis, and I say if you do 10 contracts, 20 contracts, and I talk about options a lot. I think it is best to also go into what options are, how they're structured, and how I take advantage of them in my regular trading, day trading, swing trading. And I will do another extensive class down the road of a more complex options positions. For now, the main focus is going to be just on a single long position. Long meaning buying a call option or buying a put option. Both of those are long positions because they're capturing movements in the market in their direction. A put position captures a bearish movement. A call position captures a bullish movement, bullish momentum when they're long positions. The short position is the reverse of that, and that is if you sell a call position, that call option is going to add value to you if price of the underlying goes down. If you sell a put position, that put position has value to you if the price of the underlying goes up. So that's a short position. So when I am talking about getting a call or a put position in my regular videos, I'm referring to the long positions. In this session, we will cover both long and short positions. And I just briefly touched on it, but as we go deeper, you will understand what I mean by that. So we'll talk about that extensively in this video. So that's what this video is for. Options 101, the basics of options trading. What is the definition? Options are financial instruments that are derivatives based on the value of the underlying security. Call options or put options. And underlying security could be futures, stocks, ETFs, index, crypto, currency futures, commodity futures. There are plenty of underlying securities that have options. Not everything has an option, but if they do have an option, then we will be able to take advantage of options. So, and option buyers, there's a big difference between going long and going short. Options buyer has the right, but not the obligation, to buy or sell a security of the underlying. Right? Let me say it again. An options buyer has the right, but not the obligation, to buy or sell the underlying. For example, if you buy a put position, you have the right, but not the obligation, to sell the stock, that underlying, at the strike price. So you'll capture your gains, your profits, if price goes down. Let's use Apple as an example. If you sell 120 strike price put options on Apple expiring this Friday, if the price of Apple is above 120, your option expires worthless and it has no value. If the underlying, if Apple goes to 110, your 120 is now in the money by $10. So you have the right, but not the obligation, to sell Apple shares at 120. Even if you don't have the shares, you can borrow, sell the shares, buy them back at 110, and pay back your borrowed stocks. But that's not what you would normally do in this scenario. If you don't have the stocks, what you would do is you just sell your put options for that $10 gain. So, which is in turn, right, in theory, it's selling the 120, buying the 110, giving back the stocks and taking your profits. It's the same concept, but instead of dealing with the stocks, you're just selling your put position. So let's look at it on the call side. If you buy a call option, $120 strike price of Apple expiring next Friday, if price goes below 120, by expiration, your option expires worthless and your risk is gone. That's the amount of money you've put up to buy those options. But if the stock price goes to 125, then you're in the money by $5. So in this moment, you have two options, no pun intended. You can sell your call options for that you bought at 120 strike price for that $5 gain and be done, or you can buy shares. That's another way to replace shares. You can buy the shares of Apple at 120 because your call option was at 120. Now you have the right to buy 100 shares of Apple per contract at 120, even if price is 125, 130, 1,000, 20,000, it doesn't matter. You have now gotten the opportunity, the right to buy the shares at 120. And if you had intended to own Apple shares at 120, then you would just get exercise and buy the shares, and whatever gain is there is in your account. So that's what it's meant by you have the right but not the obligation. An option seller at the other side has the obligation to buy or sell the underlying security. So let's use the Apple example again here. So Apple 120. If you sell 120 strike price put position on Apple expiring next Friday, if price of the stock goes above 120, the premium that you have collected selling those options stay in your account. Instead of buying, this time you sold, meaning somebody is buying, so they're giving you the money. So you're collecting whatever premium that other side is buying, thinking that price is going to go down, but you're thinking its price is going to go up. So you have sold the put position and you collect the money. On the other side, if price goes down and it goes to 100, for example, then you have the obligation to buy the option at 120. So you'll get exercise at 120. If you don't want to be exercised, the only thing you can do is buy back those options that you sold, but they'll be much more expensive than the premium you've collected because they are now $20 in the money. So you have that $2,000 that you have to pay back minus the premium you've collected. That would be your loss. So that's one way of doing it. Or if you had wanted to buy Apple shares anyway, and you would just be buying it at 120 even though the price is 100, and your cost for the stock is 120 minus the premium you've collected. So that's how it works. But as a seller, you have the obligation. As a buyer, you have the right. As a seller, you have the obligation. It is very critical to understand the difference between the right and the obligation. In most of my day trades examples that I give, I'm the buyer. So I always have the right but never the obligation. There are times I do sell positions. That's when I want to buy stocks, but they're stagnant. So instead of just waiting until price drops, I just keep selling premium month after month. And if 1 month's price drops, I was willing to buy the shares anyway, and I have kept collected premium along the way. And my cost basis is all those premiums added up minus whatever strike price that is. So that's how I enter most of my comments, most of my stock positions. That's how I do it. I sell puts, cash covered, and then when I get exercised, I buy the shares because I have enough capital in my account, is cash covered to get exercised. So that's how I do options selling. But day trades, 90% of the time, we're talking about buying long, buying calls or buying puts. But now you know the difference. This is a big difference, and you must understand this difference. If you don't understand the difference between right and obligation, it's going to be difficult to figure out what is my risk and what is my potential profit. So please be aware of this big difference. So a buyer, I mentioned this already, is said to be long, and the seller is said to be short. So they're traded on contracts. All options most of the time are traded on one contract represent 100 shares. There are times when there is stock splits, reverse splits, some other conditions, mergers, acquisitions, that will give you this non-standard contracts, but those are identified within your platform and they're short-lived. Once that period is over, then they go back to the normal one contract equal 100 shares. Options have a specific strike price and a specific expiration. So whenever you're buying or selling, you're selling for that strike price, that expiration. And if you're right on that strike price, that expiration, you collect your reward. If you're wrong, then that's where you have the risk. But it's for that expiration and that strike price. If, for example, you buy a call option expiring Monday on SPY, but Monday does not go in the money, meaning the price is less than your strike price, and then Tuesday goes in the money, it's too late for you because you have purchased the Monday expiration option. So as soon as Monday 4:30 p.m. Eastern time hits, those options are done. It's actually 4 p.m. that the market's closed, and I believe it's another 15 to 30 minutes where you can do the SPY options. Not many options are done that way, and I don't even worry about this. I focus on by 1 p.m. Pacific time, 4 p.m. Eastern time, the market is closed, the cash market, cash equity is closed. I am out of my position by then. I'm not taking a chance on this. Is it 15 minutes, 10 minutes, 30 minutes? I'm not taking a chance on that. So just be aware of that. And when you buy and when you sell, there's a slight difference. The options are quoted as a bid and an ask. So the bid side is where the seller collects. The ask side is for the buyer buys. And we can go quickly take a look at an option chain and look at that. For example, on the SPY, this coming up Monday expiration, you have calls on the left side, puts on the right side. In the middle is your strike price, and then to the left and to the right of the strike price is where you have your bid and ask. So if I want to buy the 412 strike price expiring Monday, then I'm buying it at $5.43 per share, meaning $543 per contract. If I'm selling it, I'm selling it at $533. There's already a $10 difference between the bid and the ask when you are the buyer and the seller. So just be aware of this difference, especially when you're getting into some illiquid assets. Sometimes this spread could be $1, $2, $3, especially as you start to go out in time, that spread could be wide, and so to get in and out, it might be very expensive. Be aware of that. Be aware of the volume. Be aware of the open interest. All of those things are important to look at, and we'll dive into those in a moment. But I just wanted to show you this is what an options chain looks like, and this is where you're selling, this is where you're buying. So selling doesn't mean you're short. It just means if you buy it at 543, price goes in your favor, and this happens to be 720 after an hour, after a day or so, then you'll sell it at the bid side. Whatever bid is at that time, if it had gone to 720 on the bid side, that's where you sell it. There are times where you can ask to go in the middle, but if you want to quickly get in, quickly get out, then you have to treat it as the bid and ask spread. That's what you're looking at. So bid side for seller, ask side for buyer. Just take a note of that and remember this. And on a call option, buyer has the right but not the obligation to buy the underlying at that strike price. Seller has the obligation to sell the underlying at that strike price. If somebody says, hey, I don't think Apple is going to go more than 120, and they sell you a 120 strike price call option expiring this Friday, and this Friday the stock goes to 140, they have to buy the shares at 140 and sell it to you at 120. They have to take that $20 loss. Or they have the stock in their account, they give up their stocks at 120. If they had bought it at 125, for example, last month, and now price goes to 120 plus a penny, they are forced to sell it to you because that's what they have committed. They didn't think it was going to go up, it went up. So a buyer has the right, a seller has the obligation. On the call side, that's what it looks like. Same concept on the put side. The buyer has the right, the seller has the obligation. But what happens is the buyer has the right but not the obligation to sell the underlying. At this time, the buyer is the one selling at that strike price. If I buy a put option and the price of the underlying goes in my favor, it means price keeps going down, the other side who sold that put position thinking price is going to go up, now they have to buy the stock at that strike price. We'll go back to the Apple example. If I bought a 120 strike price option, put option, and the seller said, nope, price is going to go up, I will sell you this to collect premium. Now, if price goes to 115, they have to buy the shares at 120. This is an obligation that they have, and they're at -5 loss, but they take away the premium they've collected, so it's not that $5 loss. If they've collected $45 in premium, then $4.55 is their loss position when they take the shares. So buyer has the right to sell it, seller has the obligation to buy it when it's a put. When it's a call, the seller and selling and buying is reversed than a put position. Slight difference, right? Because when you're buying a call, you have the right to buy the underlying. When you're selling a put, you have the right to sell the underlying. That's just how you look at it. It's a little complicated, but just keep listening to this again and again and come back to this video, and you can pause this and take a look at this multiple times, or you can send me a comment and I'll make sure I address your question. I make sure that you understand what this really means and how it works. We've gone over an options chain. This is generally what it looks like. There's the volume, open interest. We'll go into those as well. There's bid, ask, and the strike price is in the middle. In most platforms, the call is on the left side, the put is on the right side. But be mindful and just be watching out for how your brokerage firm, your platform is setting it up. One easy way to tell is as price goes up, the side where the price goes down is your call side. As price goes down, the side where the price of the option goes down, that's your put side. Because as price is going down, this is where the option premium is going to start to pick up. But for now, the one that is the most expensive is the one that's at the money. So if price is somewhere $3.94, as price goes down, then those options are cheaper because they're out of the money. Or at $3.94, as price goes up, those options are cheaper on the call side because price is not there yet, it's out of the money. So just be careful. Just understand on your platform which side is call side, which side is put side. Understand this clearly, then you can easily enter positions without making mistakes. It's very easy to say I'm buying a call option and actually buy a put option and get your direction right, but because you buy the wrong option, lose on the premium you've paid. So I just wanted to stress that out. Options are said to be in the money, at the money, or out of the money. In the money call means the current underlying price is above the strike price. We'll go back to Apple. Apple 120 strike price call option is in the money if Apple is above 120. Anywhere above 120, then that's in the money. At the money is a little tricky because it's very, very close to it. So at the money means the current underlying price is the same as the strike price. It's never the case where you have 120 strike price and the price just happens to be exactly 120. So if it's 119.85, 120.20, 120.30, that somewhere around that range, that's at the money for all practical purposes. But the definition, the true definition is 120, 120. Price is 120, strike is 120. Price is 95, strike is 95. But roughly around there, a few cents up or down from there, at the money. Out of the money call means that the current underlying price is below the strike price. If Apple shares are trading at 126 and you have a call option at 130, 127 and above, then those are out of the money because price has not reached there yet. Price has to go above, on a call option, price has to go above your strike price to be in the money. So let's look at the same thing for a put option. It's the same concept, in the money, at the money, out of the money, but where price is where the difference is. In the money put means the current underlying price is below the strike price. Apple at 120, strike price 125, you're in the money on the put side because you're capturing gains as price goes down. So as long as your strike price is above the underlying, that's a positive thing for a seller or for a buyer of an option who wants to sell it down the road for profit. So a put option buyer wants price to go down. So in the money, that's what it means. The seller doesn't want the price to go down, but the same thing applies to them. They're just positioned in negative because they were hoping to have the price go up. But in the money is the same whether you're a buyer or a seller. It's in the money for both sides. Calls or puts, it doesn't matter. In the money, at the money, out of the money applies to both sides. Shorts or longs applies to both of them. So in the money means the underlying is below the strike. At the money is the same, but again, roughly around that area. And out of the money means that the underlying price is above the strike price. Because on the put side, we're saying price goes down. That's the favor for the buyer of that put position. So if you're buying a 120 strike price and the underlying is 130, that doesn't do you any good because you capture price movement and profits when price is below 120. So as long as the underlying is above that strike price, then that is considered out of the money. So that's what we talk about in the money, at the money, out of the money. For both sides, the same concept, but difference is where the underlying is. That's the slight difference. So expiration. The expiration is the date each option contract expires. Everything has an expiration when we talk about options. Index and other derivatives could have different expirations. Like for example, the SPYs expire on Mondays, Wednesdays, Fridays for weeklies, and then third Friday of the month, everything expires that day, third Friday of every month for monthly contracts, every Friday for weekly contracts that do not have the Monday, Wednesday contracts. So everything else that has weekly is every Friday. And then LEAPs, which are long-term equity anticipation securities, they expire a long ways down the road on that third Friday of the month we've selected. So January 2022, January 2023, somewhere in 2022, as we approach 2022, some months are going to start opening up, but LEAPs are monthly expiration options. We get into weekly as we get closer to that month. So until then, we only see those monthly expirations. The strike price is the value the underlying will be exercised if the option is in the money at expiration Friday. I say expiration Friday here, but it's expiration day, because as in the example of SPY expiring on Monday or Wednesday, if it's in the money at the expiration day, then that's the strike price. The underlying will get exercised. So longs will have the right, and shorts will have the obligation to get exercised at that strike price. The volume is the number of contracts bought and sold at a particular day. So every day it has its own volume. It's not yesterday's volume, it's not tomorrow's volume, it's not last week's. It is today's volume as it is happening. So that number will keep increasing until the cash market closes. Then that volume is done for that day. Open interest does not take today's volume into account. This is the total number of open contracts. The Option Clearance Corporation, the OCC, updates this number before the next day market opens. This is when it is updated. So to have a brief example, if open interest today was 1,000 and we see a volume of 200, until tomorrow we don't know if this 200 was somebody selling from this 1,000 block that was already in play before today, or is it brand new 200 contracts that were added to the open interest. That's something we'll find out the next day as the market opens. If we see the number at 1200, it means 200 brand new volume was added to open interest. If that number happens to be 800, then we know it was purely a 200 taken out from the open interest. If it's somewhere between there, if the 200 is some selling, some adding, so it will be a number between 800 and 1200. So that's how you look at open interest. So open interest changes every day. Volume is only today's, so the next day starts at 0. Bid and ask, I think I've said this a few times, very clear. The bid is the price an option is sold. The ask is the price an option is bought. So volume is the number of total contracts for that particular day. And open interest is total number of contracts prior to today. So the Greeks, there are certain things that dictate the price of an option. The premium of an option is based on the Greeks. There are a few, and I think there are a couple more, but I will only focus on these 5. And if you understand the first 3, you're already way ahead of the game. So the way it works, first Greek is delta. Delta is how much the option value will change for every $1 move in the underlying. Delta is between -1 and 1. So a delta 1 means if price goes up by $1, the option price goes up by $1. These are usually very deep in the money options. As you get close to at the money area, you start to get around the delta 50. And then as you get out of the money, this is where you start to get to delta 10 and 0. And -1 is on the put side that you'll see, same concept. The deeper you are in the money, the higher that number you'll see. Like -1 means you're deep in the money on the put side. And as you get away from the strike price, then the delta starts to decrease. So that's how delta works. So for every $1 move, the option price will move by that delta amount. If the option strike price is $1.25 and price moves by $1 on a delta 50, then your option now has a value of $1.75 because you're adding 50 to $1.25. Gamma is the rate delta changes in relation to the underlying. Am I confusing you yet? Because I think this is a very confusing matter even to myself. So what gamma does is, if you recall, I just said if it's deep in the money, has a delta of 1, for example, on the call side. How does it get to a delta of 1? As price goes deeper and deeper in the money, then gamma says, I am going to change the delta by this amount. So if you get a gamma 10, that means as price goes up $1, then delta goes from your delta 50 to delta 60. And every dollar that it goes up by, but the gamma amount will change, and then that change will dictate how much the delta changes. So it's the rate that delta changes, not the rate the value of your option changes, but does it go from delta 50 to delta 60, from delta 50 to delta 40? Gamma decides that. Theta is the time value of the option. So there's an extrinsic value. These are long positions have negative theta and short positions have positive theta. So sometimes options prices don't make sense when you have a lot of time, because the price could be at 120 and the option price could be at $5, and you think, I'm not $5 in the money, how can it be so expensive? That's extrinsic value dictating the price of the option. Now if you have a long position and price moves against you, theta says this is how much the value of the option price decreases every day that passes by. And the closer you get to expiration Friday, the faster there's that decay. So theta decay is what is a term that you hear often. Theta decay means your option premium is going to start to decrease in extrinsic value and only hold its intrinsic value. Intrinsic value means delta minus, strike price minus the current price. That would be the intrinsic value. It only holds that. So if you bought a 120 strike price for a long time out at $5 and price is at 115, you're not making any money because you only have that $5 intrinsic value. If it goes to 110, then you have $10 of movement, but you've already paid 5, so you have that $5 gain. So I don't want to confuse you. I just wanted to throw this in. Don't worry about how much am I gaining or losing. I just wanted you to understand the concept of how options work. Then we have Vega. Vega is the rate extrinsic value will change based on implied volatility. So the more volatility, the more the intrinsic value is increased, which increases theta in return. So for example, if there's earnings coming up or if there's FDA approval coming up, then volatility for that underlying would be spiked up, which will increase the extrinsic value, which increases theta, and that's how the options premium are calculated. So if you're trading near these big events, but you have a longer time outlook, you're not trading this week's expiration, you have a longer time expiration, you have to be mindful of this, because as soon as that activity, as soon as that event is over, then you'll have theta crashing, because extrinsic value now goes back to 0. When theta crashes, the high premium you've paid will have less value. Even if you're in the money, you could still be in the negative. So be mindful of entering a long position that has a high Vega that could in turn lose value, not because the stock hasn't moved, but because the Vega was included as part of the price that you've paid when you bought the option. So just the easy way to look at this is, do not enter a long position for a long period out if it's around some major event. If there's some news event around this stock, just don't enter that. Finally, we have ROE. I never pay attention to this, but it's here for you to know what it is. It's options price change in relation to risk-free interest rate. This is the definition. So when the risk-free, meaning when the banks have their own interest rates among each other, how they lend money to each other, when this number changes, then the option price will change. I don't understand how this is calculated. I don't worry about it. I just leave it here for you to know what it means. It's just here for you. So if somebody already has a good knowledge on this, then please educate the rest of us. But I don't usually calculate this, and it has not affected my profitability because I don't look at this. So application. How does this apply? How is this used? So what is the risk on long position? What is the risk on short position? And what is the difference between stock purchases versus option purchases? That's what we will look at. So on a long position, whether you buy a call option or a put option, on a long position, your risk is the premium you've paid for that position. On a long position, your risk is the premium you've paid for that option position. You don't lose a penny more or a penny less if the stock does not move in your favor. That's your risk. It's defined, it's very clear. That's why I like them. I know how much of my total account I can risk. I can calculate that risk, and I can enter a position and not lose sleep over, even if it goes against me. That's for long positions, whether it's call side or put side long positions. That means you are buying the option on either side. Short position, the risk is a little bit different. On a call side is significantly different than a put side as well. So let's start with call side. On a call side, your risk is infinity. Your risk is infinity. Why? Let's say you sell a 120 strike price Apple option contracts, call 120 strike price call options, and the price of Apple in theory can go to infinity. So your risk is infinity minus 120, which is infinity. That's your risk in theory. In practice, it could go to 140, it could go to 200, it could go to 250. That we don't know. I mean, maybe infinity is not reality, but reality is it could go to a very big number. Some big news might come. Apple is about to have XYZ thing happen, and the whole world is going to buy this product, and Apple price might go up $100, $150. We don't know. So that's the risk you're taking on the call side. Extremely high risk. On the put side, it's a little bit more defined risk, but it is still a high risk. Because if you sell a short put option, so let's say again 120 strike price, and you sell 120 strike price put option, and the price of your underlying of Apple goes to zero. Again, theoretically, it could go to zero. If it goes to zero, you are forced to buy it at 120 and sell it at zero, or just keep the stock forever. So your risk is more defined, but it is still a high risk. Now your risk is 120 times 100. That's your risk. So $12,000 per contract is your risk on selling a short put at a specific strike price. Long side, your risk is limitless. Short side, your risk is the strike price times 100. That's your maximum risk. So what's the difference then, once you understand this, between stock purchase versus options purchase? Because the risk is kind of similar. So you can sell a stock short and still have that unlimited risk. You can sell call options and still have that limited risk. But the big difference is how much capital is required to control 100 shares of your underlying. So if we take ZM as an example, Zoom, and let's just randomly pick some number. A few weeks ago, Zoom was at 339.76. I just picked that number. So 100 shares of Zoom, if you were to buy it outright, would cost you $33,976. Now, instead of spending this, you can say, well, there is a May expiration, $330 calls. I can buy at $34.50. So times 100. Remember, I said contracts in options are 100 shares. One contract equals 100 shares. So the price quoted, you have to multiply by 100 because you're controlling 100 shares. So if you say calls at $34.50 times 100 shares, it's $3,450. That's roughly 10% of the cost. So you spend 10% less, but you control the same 100 shares. You control and capture the same move of the $100. So your risk reward is much greater. Options does not make it any more probable than stocks to hit your target. That's not what it means. It just means you spend less to capture the same movement. Now, the return is different because you spent less. You spend less, so on the option side, your reward is much bigger. You have much higher chance of, even if price moves by 10%, like it goes from 3,450, it goes to roughly, you add $300 to it, so 3,800 roughly to that, you're capturing 10% gain. But on the stock side, to capture that kind of move, price has to go up significantly to capture a 10% move. To capture a 10% move, you need price to go up so that you can capture $3,400. So that means you need price to go up by $34. Whereas in the options, you just need price to go up maybe by $1, $1.50. So this is where the big difference comes between stocks and options. But here's where you also have to be careful. If you have $34,000 to buy 100 shares, and that's all you have, then by all means, never, never, never buy enough options positions to spend all that $34,000, because options could expire worthless. So you don't want to go to zero overnight. You just take one. You were able to buy 100 shares, just take one position. That's how I look at it. Now, if you say, well, I have tight stop losses, I can do 2, I can do 5, fine. That's acceptable. But know your risk and manage your risk very tightly if you enter more than one position. If you enter one position, then what you have risks is 10% of your account size at the worst case scenario. That's not what I am suggesting. I never suggest for you to risk 10% of your account size. 3 is the max I recommend. Between 1 and 2 is my sweet spot. But as an example, in this Zoom example, it will cost you 10% less in options. Then you can just manage that as well. So let's take this a little bit further, right? One step further. Instead of buying the May options, let's say you do LEAPS, long-term equity anticipated securities, right? So you buy a long-term, like 9 months plus options. January 2023, $330 call. When I did this, about 10 grand. Let's say that's how you want to structure it. It costs you 10 grand. But instead of spending 10 grand, you say, then I will turn around and sell a higher strike price, maybe 410 strike price, at $500. Then instead of spending 10 grand, you spend maybe 9,500, somewhere around these figures. Then if it's called out, you have 7,000 exercised, losing $2,280, right? If 410 is exercised and you have bought the 330, sold the 410, you have this $70 in between that you're playing with, right? So $80 minus the premium you've collected, that's the risk you are taking. So just something to keep in mind. So application, risk on long term is the whole amount of your premium. Risk on short position, I meant long term, not long position, not long term. Risk on long position is the premium you've paid. Risk on short position is just huge. So I want to be very, very careful structuring it this way. Now, because today's lesson is option 101, we will do option 201, where I'll go into fancy setups, spreads, vertical spreads, calendars, diagonals, different kinds of spreads you can utilize to minimize your risk on both long position and short position. But that's another lesson by itself. So today's lesson is just focus on long positions. This is what I talk about when I do my market analysis. This is the SPYs, IWM, diamonds, Qs. These are the positions I take, are long calls or long puts. That's my defined risk. But I could structure it in a way that says, hey, I'm willing to buy these options because I want to buy the shares. This is how many shares I buy as well. So that's the shorter term application. So don't forget, this is just 101. If you're new to options, there's plenty of learning. So keep coming back to this video, keep giving me comments so I can really help you be successful at what you do. Alright, hopefully this is a very informative and educational video for you. Don't forget to like it. That encourages me when I see those likes. And again, I'll remind you, don't be shy about giving me comments, giving me comments so I can help you add value to your learning. Alright everyone, take care, and I'll see you in the next video.